A very good morning to all of you students. Today we will be starting our discussion on interest rate risk management. So let's first start with some of the basic concepts in the interest rate risk management, and then we will be covering some of the questions to understand it better. So first of all, if I may ask you that why the interest is required to be paid, or what is the essence of an interest? So, anybody would want to contribute their thoughts? Why is interest? So, the question is, let's say, whenever we give any money to someone, why do we expect interest out of it? What are the broad reasons you feel that interest should be paid? Okay, Sumit is saying time value of money. I can take that, that's okay. Apart from this, any other factor do you think? Why is interest being paid? Good morning, Jinyoja. Yes, students, come on. So one is I'm just mentioning the time value of money, which is rightly said by Sumit. Is there any other factor because of which I will charge interest, or let's say I will charge higher interest or lower interest? Some other factor that will determine that? Earning something from idle money. Yes, that's what the interest is, right? But I'm saying ki why or what factors will influence the interest? So one is definitely time value of money, which I'm saying, let's say inflation, right? Inflation slash time value of money. To understand it better, the time value of money, we always take an example where we say that if today a standard basket of goods is worth 100 rupees, so 1 year from tomorrow, the same standard basket of goods will be worth 120 rupees, right? So this 20% increase in 1 year denotes inflation, or in other words, it's the deterioration of the time value, deterioration of the value of the money because of the passage of time. That's why it is called as time value of money, because money will lose its value over a period of time. Correct? The same 100 rupees that can buy a basket today will not be able to buy the same basket 1 year from now, because in that case 120 rupees will be bought. So if you lend someone 100 rupees today, you will expect 120 rupees after 1 year, right? Because the value of money has deteriorated. So you will expect higher amount of money when you get it back after 1 year. So definitely yes, inflation or time value of money is definitely going to be the first factor. And the second factor, the second broad reason why interest is being charged or paid is the risk of what? Risk of non-payment, which is also called as default risk, right? If I lend someone some money and the other person is not able to repay me back, I will regard that probability as risk, right? Risk of non-payment. It can be for interest, it can be for principal, right? So if let's say the risk is higher, now I think this one is simpler for all of you. Now tell me, if risk is higher, let's say I am lending it to a startup, right? Because in a startup the cash flows are yet to get matured, right? They are still evolving, so I don't know whether the repayment can occur or not, so the risk is high. If the risk is high, risk of giving the money is high, what do you expect the interest to be? Whether it will be higher or lower? What do you expect interest to be?
Higher
Whether
interest.
it will be, yes, it will be higher interest. Reason being, because to compensate for higher risk, you will demand higher return on your investment, or let's say on your lending that you have given. Correct, because you are undertaking higher amount of risk. Similarly, if the risk is lower, you can settle at a lower interest rate. That is okay with you, right? That's not going to be an issue. Now, with this, let's start our discussion on interest rate risk management. Now, as the name suggests, so this interest rate is the underlying today that we are going to talk about. And risk management is how do we manage the risk? First of all, how do we assess the risk? That what is the risk? Second, how what all techniques are available to manage the risk? Right? This is going to be our subject matter today. Okay? Clear? But I have already told you the background why interest is being charged or paid. Right? And because these two factors are there, can you tell me the interest rates are static or dynamic? Do you think interest rates are static or dynamic? Come on, students, tell me. In practical life, have you seen interest rates to be static? Static means it is fixed, it is never going to change. Dynamic means it keeps on changing. It's dynamic, yes, Ojajini, you're right. It's dynamics, it's not static. Now, why it is dynamic? Because if the inflation keeps on changing, interest rate will keeps on adjusting itself because of the inflation. If the risk is also different for different parties, right? Accordingly, the interest rates will change. Further, there are a lot of other factors in an economy because of which the interest rate changes. For example, the central bank RBI keeps on changing the monetary policy related rates, right? That because of that the rates, overall rates appearing in the market will change. The rate at which the banks borrows also keeps on changing because of the demand and supply of credit in the market. I'm just giving you some of the examples. Okay, so we come to know that since interest rates are dynamic, there is a risk of what? Risk of interest rate movements going in a adverse direction, right? So if I may say, interest rate risk is actually changes in interest rate, right? What is risk? In portfolio, you would have studied what is risk. In derivatives, we also studied what is risk. Risk is the possibility of actual outcome to be different than the expected outcome, right? I expect that interest rate should be 7% and I am going to borrow. This is that. But actually, the interest rate after 1 year became 8%, right? So, this is the possibility of the actual return, or let's say actual percentage, being different from the expected percentage. So, this 1% increase will impact me, right? It's a risk for me. And since there is a change in the interest rates, there is an interest rate risk involved for which we have to do the techniques, for which we have to understand the techniques how we can mitigate the risks, right? Now, it will impact the financials of the company, right? Interest rate risks, or let's say changes. Interest rate changes impacts financials of the company. For example, I have borrowed some amount and the borrowing is on and the borrowing is on variable rate basis, not on fixed rate basis. So the moment the interest rate changes, it will impact my interest cost, it will impact my interest income, right? So all those things will come into play. Now, let's talk about how we can manage the risk. So hedging is what? Hedging is managing the risk, right? We already have a risk exposure. Through hedging, we try to curb that risk exposure. Okay. So hedging interest rate risk. Okay. So in this, if we see, there are two different buckets in which all the methods have been classified. One is traditional method, second is modern method. Now, traditional method we have two. First one is asset and liability method, which is also called as ALM, asset liability mismatch, asset liability method, whatever you want to call it. Then the second one is forward rate agreement. This is also called as FRA. This is called as ALM. Okay. Then modern methods. Modern methods, we have interest rate futures. Second, we have interest rate guarantees. And lastly, we have swaps, interest rate swaps, right? Okay, students. So these are the three different modern methods that we are going to study. Yes, I think Supriya had also answered compensation for risk. I just now saw that in the query handle. Yes, Supriya, you were right. Okay, perfect. So, so these are the five different methods that we have to study. That is these are the methods that will be used to do the hedging of interest rate risk. Now let's come to the very first part, which is the asset and liability method. So let me explain you this asset and liability method. Does anyone know what is this exactly? If practically some of you would have seen in some of the banks or NBFC following these methods, which is very, this term is very, famous term for in the banking industry, ALM. Yes, if somebody wants to attempt, or otherwise. So, okay, let me tell you. If you see a balance sheet of any bank or any company for that matter, okay, if you see any balance sheet, it has assets and liabilities. Yes. Now, liabilities will have different maturity profile and assets will have different maturity profile. It is not necessary that you will realize your assets and at the same time your liabilities will fall due, because in practical world in any of the business it's not that case, right? Maybe I will be realizing my debtors in 90 days, but I have to pay my creditors within 30 days, right? So what I am going to do, I have to, so in ALM method, we are just trying to match the timing of cash inflows with the timing of cash outflows in such a manner that your assets and liabilities maturity profile is actually matched. Because if you see, the need to borrow or the need to invest arises because of the differences in the maturity profile. Now, in the first case that I have spoken about, 90 days and 30 days, right? Creditors we are paying in 30 days, debtors we are realizing in 90 days. Now, here there will be a need to borrow for 60 days, right? Which is from 31st day to 90th day. So in a way, what you know, let's say basis the analysis, if we can push the debtors to, let's say, come to at 45 days, and similarly creditors also to 45 days. That is one where we're trying to match the, maturity profile of both of them. Or in between, if we have some other realization of cash that is going to happen on the 30th day, can we use that? So these are the different analysis that one need to perform to make sure that the timings are matched. If the timings are matched, your need to borrow or your need to invest, and hence your dependency on the interest rate risk will reduce. Okay. So timing of cash inflows and cash outflows, here is what we do, matching the assets maturity with the liability maturity. Okay. So this is it. I think there is nothing much in this. The Let's jump to the other one, which is the forward rate agreements. Okay, now please understand this very importantly, because I think for most of you this will be a new concept altogether. Okay, now let's say there are two banks, Bank A and Bank B. So Bank A needs to borrow after 1 month for 3 months, rupees 1 lakh. Clear? The situation is clear. The bank needs to borrow money, but not today. Bank already knows that after 1 month, so through this ALM method, let's say ALM method, the bank is able to identify that after 1 month it will need 1 lakh rupees to be borrowed, and it will need for 3 months. And on the same hand, Bank B needs to invest for 3 months after 1 month, rupees 1 lakh. So here bank B needs to invest, bank A needs to borrow, and rest all things are same. After 1 month they want to actually execute it, and the maturity, or let's say the tenure, will be for 3 months. The current interest rate, which is appearing as on today, is actually 5% per annum. And there is a term which I'm just sharing with all of you, forward interest rate. Can anyone tell me what will this mean? And this is a forward interest rate of 1 month. So this forward interest rate means that if the borrowing or lending happens after 1 month, so as on today, the rate that is quoted for borrowing or lending to happen after 1 month is 6% per annum. This is called as forward interest rate. So this will not be used to execute as on today. Okay, this will not be used to execute as on today. This will be used to execute any borrowing or lending after 1 month. Clear? This is called as forward interest rate. Students, please do let me know in case is there any doubt. I hope the discussion is clear till now. Okay, perfect. Then let's say we are at 0th month. We go to 1 month from now where the actual lending or borrowing has to happen, and that will happen, let's say, for 3 months. So we arrive at 4th month. Correct? So D is equal to 3 months. D means duration. Duration for this is actually 3 months. So this entire arrangement will be quoted by this terminology as FRA 1 by 4. So this is a standard terminology, FRA 1 by 4, wherein we will say that this is a forward rate agreement. 1 means it will start after 1 month, and 4 means 4 minus 1, which is this minus this, will be the duration, which is 3 months. Clear? So it will start at first month and end at fourth month. Clear? So this is called as, so this is the standard terminology. Now for FRA, can anyone tell me what will this mean? Tell me what will be the duration of this FRA and what will be the starting point of this FRA.
Starting point after 3 months, ending at 6 months, and the duration is 3.
Correct. Very good. Now, I hope for all of you students this is clear. Now let's take another example. FRA 12 by 18. Similarly for this also, the starting month at which the actual borrowing or lending will happen will be
12th
what?
month,
Very good. And duration will be for how many months?
6 months.
Yes. So on 12th month it will start and duration will be for 6 months. Clear? Now let's come to over this example, right? So now we are talking about a FRA of 1 by 4, right? For both the banks. FRA 1 by 4 for both the banks. Now let's see what is the situation after 1 month. This is from bank A's perspective and this is from bank B's perspective. Let's say the 0th period they enter into a FRA, right? They enter into an agreement. So forward rate agreement is also a kind of agreement where they agree to borrow or lend after 1 month for 3 months at the rates specified in that agreement. So the rate that is specified is 6% per annum. Clear? And bank A will say that I will borrow and bank B will say that I will invest. So this is a agreement that they did on the 0th period, and the rate that they have locked is 6% per annum. Clear? Now the first period. Now, if at the end of the first period, let's take different cases, right? Let's take case 1, wherein the actual interest rate is 8%, right? So if let's say the actual interest rate has jumped up to 8%, then from bank A's perspective, bank A has a forward rate agreement to borrow at 6% per annum. However, the market rate has become 8%. So do you think it's a gain for bank A or a loss for bank A? Just apply
Gain.
the same principles that we discussed in derivatives and think it from that perspective. Bank A has a forward rate agreement to borrow at 6%. Market rate is 8%. So is there a gain or a loss? Come on, students, tell
Gain.
me.
Gain
Gain of
of
Gain. Very
2%.
good.
2%.
Very good. Very good. So gain of 2%. Now, from Bank B's perspective, now Bank B has a forward rate agreement to invest at the rate of 6%. However, in the actual market, the rate it can get is 8%. But because Bank B has entered into the agreement, Bank B will have to invest at the rate of 6% only, right? Bank, I'm not saying that they have an option. As of now, we are not talking about that because in derivatives, we first studied forwards, then we studied futures, then we studied options. So here also we are starting with forward. So this forward rate agreement is the forward equivalent of derivatives. Okay. So there is no choice. If it is an agreement, it can become an obligation also, or it can become a right also later on. Right. So here it is a loss. Correct. The second case, let's take where the actual rate is 5.5%. Now, in case the actual rate is 5.5%, then for
Loss of
bank
0.5.
A, very good. So for bank A, there is a loss of 0.5%. Why? Because had bank A not entered into this agreement, bank A would have simply borrowed from the market at 5.5%. Now, because this agreement is there, the bank A has to borrow at 6%, which will lead to the loss of 0.5%. And here, if we talk about, there is a gain of 0.5%, because here the bank will realize 0.5% more because of this forward rate agreement. Okay. Now, if we elaborate it further, so in case of option one, now see how payoffs will get settled. Okay. Bank A would get 2% and bank B would pay 2%, right? See, in our derivatives also we saw that there are two ways to settle, right? One is gross, one is net. In case net settlement is happening, then 2% differential will be paid. And in case gross settlement is happening, then actual lending and borrowing will happen at the rate of 6%. I'm sorry, which is kind of an actual delivery, right? So here let's talk about the payoffs on a net basis. Okay, so 1 lakh was the amount, 8% minus 6% for 3 months. So this is the differential that will get paid, which is 2% equivalent. But this will be paid at the beginning of the FRA. So generally I'm saying the FRA, whenever it starts, at that point of time, the differential is paid. So we will take a present value of this by dividing on the 8% for 3 months. So this becomes 490.19. So this is what? This is basically present value at the start of loan. Clear? Now let's come to option 2. Now here bank A will pay 0.5%, bank B will receive 0.5%. So the net amount that will be paid or received is on 1 lakh multiplied by 6% minus 5.5% into 3 by 12 whole divided by 1 plus. Now here what rate I will use? The actual rate, right? For doing the present value, I'm not going to use the FRA rate. I'm going to use the actual rate. So 5.5% into 3 by 12. I hope this is clear. 123.31. So bank A would pay 123.31 to bank B. I hope this is clear.
Yes, sir.
Perfect. Now with this, let's derive our formula, which is an easier one. So the payoffs will be calculated as N multiplied by RR minus FR multiplied by T whole divided by 1 plus RR multiplied by T. So here N is equal to the notional amount, which is the amount of the loan borrowed or lended. Then RR is actually the actual interest rate. Clear? Then FR is actually the forward rate. This is agreed in FRA, and T will be the time period for duration that we call, right? Clear, students? Now, if I may say finally, Bank A, who is the borrower, and Bank B, who is in the lending position, right? He's the lending bank. The term that we use to call them is that the person who has the borrowing position in FRA is called as the person who has purchased FRA. And here we will say that this person has sold FRA. Like forwards, there is a purchase buyer and a seller, right? So for buyer, we call it always call it as a long position, right? For seller, we call it as a short position, right? Here, if the interest rate increases, so the gain will also increase. If the interest rate decreases, um, let me put gain only will decrease. Okay, gain will decrease or loss will come into play. Okay, here if interest rate increases, then gain will go down, right? Because the moment higher interest rate is coming in the market, I will lose that opportunity to invest at the higher rate in the market, right? Because I have to exercise the FRA at a lower rate. Clear? Similarly, if interest rate is going down, then the gain is going to increase, right? We are talking about the net payoffs. The same thing that we just now discussed. Students, I hope this is clear till now. Please let me know in case of any doubts.
Yes, sir.
Clear? Very good. Let me see, are there any other questions in the... No, there are none. Okay, now let's move to question number one. Okay. Ankush Limited has a plan to raise an amount of 50 crores for a period of 3 months, 6 months from now. Now tell me, students, what is the FRA that they are talking about? What is the denotion of FRA I should write? FRA what by what?
6 into 9.
Very good. Why 6 into 9? Because 6 months from now, for 3 months, so 6 plus 3, 9, right? And he has to raise an amount, that means borrow an amount for 50 crore. Okay, so we are talking about a borrowing position for 50 crore. Notional amount is 50 crore. The current rate of interest is 9%, but it may rise in 6 months' time. The company wants to hedge itself against the increase in the interest rate. Bank of India has quoted a forward rate agreement at 9.1% per annum. Find the effect of FRA and actual interest cost to Ankush Limited if the actual interest rate after 6 months happens to be 9.5 or 8.5. They have given us the two different scenarios and I have asked us to calculate the impact on the interest. Right? So here we are talking about an FRA of 6 by 9, which is entered into 9.1% interest rate. So here if we talk about case 1, actual interest rate is how much? 9.5, right? So if the actual interest rate is 9.5, whether the Ankush Limited will gain or lose?
Gain 0.4%.
Very good. It will gain 0.4%. So let's calculate the payoffs. We will use the same formula N RR minus FR into T divided by 1 plus RR into T, which is equal to 50 crores into 9.5% minus 9.1%. This will be for 3 months, and we will take a present value of this at the rate of 9.5 percentage, which is the actual rate of interest. So this comes out to be 4,88,400. Clear? So this is a gain to Ankush Limited, right? Now let's see the overall impact to Ankush Limited. Payment of interest at the rate of 9.5% will happen, right? So this will happen on 9.5% on 50 crores into 3 by 12, right? So this will happen 1 crore 18 lakh 75,000. Then whatever gain on account of FRA is there, which will be reduced to arrive at the net interest cost, right? So that is 488 400. So the net amount becomes 113,86,600, and hence the effective borrowing cost, can we arrive it in percentage? 113,86,600 divided by 50 crores into 12 by 3. Correct? Because this is for 3 months, right? This interest rate is for 3 months. So it will become 9.10, 928 percentage, or can we say approx 9.10 percentage, right? Which is equivalent to the FRA rate of 6 by 9. Clear, students? I hope this is clear.
Yes, sir.
Perfect. Now the second case is actual interest rate is how much? 8.5. In this case, there is a gain or a loss to Ankush Limited
Loss.
of how much?
Point 6.
0.6%, right? Yeah. So 50 crores multiplied by 8.5% minus 9.1%, 3 by 12 divided by 1 plus 8.5% for 3 by 12, which is effectively rupees 734 394, and here it will become a loss. So the impact on Ankush Limited will be pay interest at the rate of 8.5 percentage, 8.5% on 50 crores into 3 by 12. This will become 106 25,000 plus payoff for FRA will also be there, right? 734 394, and hence the totality, it becomes total interest cost 113,59394. Effective borrowing cost becomes how much? 113,593,94 divided by 50 crores multiplied by 12 by 3. So this is also 9.0875 percentage or approx 9.10 percentage. So the same rate which is there as a part of FRA 6 by 9. Yeah. Clear, students? This was easy and simple. Any questions till now, students? I think the topic is relatively easier because if we have our base ready from, let's say, derivatives, so it's a derivative on interest basically, right? On the interest rates, where the underlying is interest rate, and this FRA is one of the derivative on the interest rate. Clear? The same way you used to calculate payoffs in derivatives, the same way we are calculating the payoffs here as well. Now let's come to valuation of FRA. Similarly, there was a valuation of forwards there, right? Here there is a valuation of FRA, which is the forward of interest rate, right? Valuation of FRA. FRA, let's take an example of 3 by 6. Okay, to understand the valuation better. So, so let's say this is 0, and then this is third month, and then finally this is the sixth month, right? So we have to find out for this period what is the interest rate going to be. So let's say as on today, we know that what is the 6 months interest rate. That is, let's say, 5% per annum. So students, one more thing. Practically, if you see in the market, the interest rate per annum is actually different for different maturities. So today, if you want to book any FD with the bank, you would have also noticed that the bank will give you higher interest rate if you do a FD of more than 1 year, more than 2 year. But if let's say you do a FD of only 6 months, the bank will give you lower interest rate, right? And I'm still talking about per annum basis, right? Which is a comparable interest rate factor. Why this happens? Because if the period is higher, generally the interest rate tends to be higher, because then you are committing to lock your money with the bank for a higher period of time, right? The same principle applies in all other situations as well. If you if you kind of commit yourself for a longer period, you will end up having a different rate of interest with a smaller term. Now let's say there are two different maturities operating in the market, right? 0 to 6 months, which is 5% per annum. 0 to 3 months, let's say it is 4% per annum, right? So this is the interest rate for 3 months. Now we have to find out this 3 to 6 months, right? This is what we need to find out from a FRA perspective, right? What is the rate going to be there after 3 months for a duration of 3 months? Okay. So if we say, let's say here duration is 3 months and this we assume to be X percentage, then can we write this formula 1 plus 5% into 6 by 12 will be equal to 1 plus 4% for 3 by 12 multiplied by 1 plus x percentage into 3 by 12. So ultimately we are saying whatever value of 1 will be there after 6 months by applying a 5 percentage per annum, the same value will be derived with two different intervals of 0 to 3 months and 3 to 6 months, and the accordingly rate of interest we have taken over here. So if we solve this, we arrive at x is equal to 5.94 percentage. This is called as theoretical minimum value. Easy and simple. Okay, students, because why it is called as theoretical minimum value? Because this is the value at which if the FRA is undertaken, there will be no gain, no loss, provided the actual interest rate is 5% per annum for 6 months and 4% per annum for 3 months. Right? Clear? So this is the formula for valuation of FRA. So what we have to do, we have to take the outer month, right? The overall duration and use it to apply with the two intervals that we have, right? Because standing as on today, we will have the interest rate for 6 months. Standing as on today, we will also have the interest rate for 3 months, right? What we will not have is the interest rate after 3 months for another 3 months. That is what we have computed here. Now let's take this further. Now, if let's say case 1, if I say that FRA is available at lower than 5.94 percentage, right? Because 5.94 is something that we have computed. Let's say in the market, FRA is available at lower than this value. Then can we say that FRA is underpriced or overpriced? Come on, students, tell me. If ever FRA is available to you at less than 5.94 percentage, whether you will call it as underpriced or overpriced.
Underpriced.
Very good. You will call it as underpriced because as per the value, it should be 5.94%, but it is available at 5.9%. So it is undervalued. Now, in case something is undervalued, what you do with that? If FRA is underpriced,
I will purchase
you will
FRA.
take a very good. You will take a long position in FRA. Or can I say that you will borrow through FRA, right? We will borrow through FRA because just now I said that long position in FRA means borrowing through FRA, taking a borrowing position in FRA. Clear? Short position in FRA means taking a lending position in FRA. But short position you will do when? When it is overpriced, right? When it is overpriced. Now standing here, again I will let's say 3 months and this is for the 6 months. Now this part is clear, right? So 3 to 6 months, which is the FRA period, we are saying that we are borrowing here, right? So if you are borrowing here, definitely 0 to 3 also you will have to borrow,
Yes.
right? Here also we have to borrow and 0 to 6 months we will invest. I'm talking about a hedging position here. So what you will do? You will borrow on 0th month and do the investment for 6 months. Okay. So here you will do two things. Borrow for 3 months. And second thing that you will do is you will enter into a FRA purchase position of 3 by 6. And third thing that you will do is invest the borrowed amount for 6 months. Clear? These three steps you will take on the 0th day. Okay. Now, the moment you do this, let's say borrow one that you did, which is the actual borrow for 3 months, right? 1 lakh rupees you borrowed. Let's say you will have to pay 1 lakh 3,000 after 3 months. Okay. So this is the maturity of first borrowing. Then second one, you will do the FRA of 3 by 6, which is borrow 2, right? So this will happen how much? 1,06,000, right? So let's say 1,03,000 becomes 1,06,000 under the FRA after 6 months, right? And what you have done, this 1 lakh you would have invested for 6 months, right? And let's say the investment proceeds that you get is 1,07,000, right? So ultimately you will have to pay 1,06,000 under borrowing one and borrowing two put together. That means actual borrow and FRA borrowing put together. And you earned 1,07,000. So that means your net arbitrage is 1,000. Clear? So I'm just telling you, I mean, you will see, you will check it from the questions or you will understand it better from the questions also. And this 1,03,000, 1,06,000, 1,07,000 is just an hypothetical figure to just make you understand it better. Okay. So I hope this strategy is clear, right? So if FRA is underpriced, I will have to take a long position in FRA. If I take a long position in FRA, even for 0 to 3 months, also I will end up borrowing. That means whatever amount I have as on today, I will invest for the 6 months, right? And then I will be able to arrive at some profitability. Okay. Now let's take the another example, case 2, where FRA is available at a higher rate. FRA 3 by 6 is available at higher than 5.94%.
Short
We will
position.
say that whether it, yes, can we say that it is overpriced? Yes. If it is overpriced, then we will do the short sell of FRA. That means we will take a lending position in FRA. We will be in the position of bank B in our previous example, right? Bank B was in the lending position, right? Now, can I say that I will invest through FRA? Now, if I put the same chart, this is 6 months, this is 0, 3, and then 3 to 6. So here, what I'm doing, I'm investing.
Invest.
Yes, I'm investing through FRA. So 0 to 3 months also I will have to invest. I'm putting as investment one and I will
Or
borrow for 6 months. Yeah. Okay. So what I will do on 0th month, I will borrow for 6 months. Whatever I borrowed here, I will put a investment for 1 month, investment one for 3 months, whatever is the rate appearing. And I will also enter into a FRA of 3 by 6 as a lending position, right? I will sell this FRA of 3 by 6. I can say that. So ultimately, if I do that, I will be left with some gain or some loss. Definitely gain here, not loss, definitely gain here because the actual price appearing is higher than the 5.94, right? So I will be definitely left with the gain over here. Clear? Now, as I said that, so this discussion is clear till now, is over till here. Please let me know in case something is required to be discussed or something is not understood. Then ultimately, we also discussed about the settlements, right? One is the gross settlement, second one is the net settlement. So net settlement we already have solved for as well, right? Pay or receive net. The formula is also shared, right? And here there is no need to actually borrow or invest through FRA. That you can do through your regular outside the market operations, but here you will pay or receive the net amount. Here, here you will do the actual borrowing or lending at the rates which are specified in FRA. Clear? Yeah, students. Now let's come to interest rate futures. Till now we discussed what? Till now we discussed FRA, which is the forward equivalent of derivatives in interest rates. Now, interest rate futures is the futures equivalent of derivatives in interest rate risk management, right? The difference between forwards and futures was what? Forward is a customized agreement. Future is the standardized agreement. Future is traded on the stock exchange. Now, interest rate futures are something which are also standardized, but these are linked to the bond prices. These are linked to the bond prices. How? So, bond price, all of us know that, is actually inversely proportional to the interest rate changes. I hope this is clear, students. All of you would have studied under the bond valuation that if the interest rate in the market goes up, the bond prices will go down or up.
Down.
Yes, if the interest rate goes up, the bond prices will go down. If the interest rate goes down, bond prices will go up. Similarly, if the interest rate, so here what we're talking about is that you have to do the purchase or sell of the bonds futures, because in market there is nothing called as interest rate futures. So interest rate futures are represented by the bonds themselves. Now, since bonds will move in the reverse direction of the interest rate, hence you have to be a bit careful. So if let's say the interest rate is going to go up, what should I do in the bonds market? Whether should I sell the bonds futures or whether should I purchase the bond futures so that I will gain?
Sell.
Yes, I should sell the bonds futures, because bonds futures, if the interest rate goes up, bonds prices will go down. And if the bonds prices will go down, I should be in a short selling position to get a gain out of it, right? So I should sell the future. So bonds futures, I'm going to short sell. Similarly, if interest rate goes down, that means the bond prices are expected to go up. If the bonds prices are expected to go up, I should purchase the bonds futures.
Long position.
Yes, we will take a long position. Clear. I hope all of the other students are also clear on this.
Yes, sir.
Perfect. Now let's go to question number 2, students. Just a second. So Electra Space is a consumer electronics wholesaler. The business of the firm is highly seasonal in nature. In 6 months of a year, the firm has huge cash deposits, and especially near Christmas time and other 6 months, firm cash crunch. leading to borrowing of money to cover up its exposure for running the business. So 6 months it has good amount of cash because the sales are good, seasons are clocking, seasonal period is clocking, but the another 6 months there is a shortage of cash because the sales are not that much for your day-to-day operations. They have to borrow the money. It is expected that the firm shall borrow a sum of euro 50 million for the entire period of slack season in about 6 months. So slack season is the other 6 months which is not seasonal, right? Slack season means the slow period. So it is going to come in 3 months. Now, can you tell me? Acha, let's read it further. A bank has given the following quotation: spot rate is this much, 3/6 FRA is this much, 3/9 FRA is this much. So, first of all, students, can you tell me what is the right FRA that will fit to us in the given case till now?
3/9.
Very good. 3/9. Why 3/9? Because the period of slack season is going to come in 3 months from now. So that means the starting period will be for 3 months and it will continue for 6 months. So that means it becomes 3/9. Clear? So this becomes 3/9. So for 3/9, if I borrow, the rate that will be applicable to me is this much, which is the bid ask difference, which is the bid ask rate, right? Similarly, if I, so let's say these, I hope all of you know how these two rates works, right? So if I want to purchase something from the bank in forex, I will take the higher rate, right? If I want to sell something to the bank, I will take the lower rate, that is the bid ask rate. Similarly for this also, if I have to borrow the money from the bank will charge me 5.94%. If I want to invest with the bank through FRA, the bank will give me 5.64 percentage. Clear? So here the question is telling us to borrow, hence the applicable rate will be 5.94% for 3/9 FRA. Clear? 3 months, 50,000 euros futures contract maturing in a period of 3 months is quoted at 94.15, which is an annualized rate of 5.85%. Please remember this is for 3 months, okay, not for 6 months. Our required maturity profile is 6 months. You are required to determine how FRA should be useful if the actual interest rate after 3 months turns out to be 4.5, 6.5. This is clear. Let's start with this first of all. So A part. So basis facts given in the question, Electra space needs to borrow euro 50 million through FRA of 3/9 at the rate of 5.94 percentage. Clear? And hence we will calculate the gain or loss. So calculation of gain slash loss. We have been given two different scenarios, 4.5% and 6.5% if the actual rate turns out to be this. So in both the cases, we have already purchased FRA at the rate of 5.94% and here also 5.94%, right? So here, if I've purchased the FRA at 5.94% and the market rate drops to 4.5%, that means I have a loss or a gain, students. Come on, tell me.
Gain.
Oh, why gain? I have
First
purchased
step,
the FRA.
loss, loss, loss.
Yes, it will be a loss. If we talk about 6.5 here, 5.94 is what we have purchased the FRA. Market rate is 6.5. So will I be at a gaining position? Yes, because I can borrow below market. at the rate of 5.94%. Market rate is 6.5%. So 0.56 percentage there will be a gain, right? Now, if we talk about the FRA payment, here there is a loss, so I will have to pay, right? How much I will have to pay? 1.44% is the differential rate of interest on 50 million euros for 6 months, right? So I will end up paying 360. And here 0.56 percentage is the gain on 50 million euros again for 6 months. So I will end up receiving 1,40,000. Okay. And the regular interest payment will happen on the market rate, right? So this case 4.5 percentage on 50 million euro for 6 months. This will be 11,25,000. And here 6.5 percentage on 50 million euros for 6 months. This will become 16,25,000, which is 1.625 million. So here in totality it becomes how much? It will become 11 lakh 25 plus 3 lakh 3 lakh 60,000, right? Because both of them are payments, right? So it will become 14 lakh 85,000. And here 1625 is the payment, 140 is the receipt, right? So net level it will still become 14 lakh 85,000. So in both the cases, the net amount to be paid becomes 14 lakh 85,000. So by entering into FRA, the rate of 5.94 percentage is committed, and it will be operational also, right? So 14 lakh 85,000 divided by 50 million for 6 months. This will become 5.94 percentage. Clear, students? This is a regular FRA that we have solved for till now. I hope this is clear.
Yes, sir. Clear.
Okay. Now, sorry.
No, sir, I was telling clear, sir.
Okay. Okay, no worries. Thank you. So now let's move to the second part of the question, which is the new concept that we discussed about the futures. Now, how 3 months future contract shall be useful for a company if the interest rate turns out to, as mentioned in part A above. Okay. Now they're saying that you demonstrated to us if let's say the company had entered into the not into FRA but into the futures position, then how would it would have held? Now, this futures contract of 94.15, how this 5.85 is arrived? 100 minus 5.85 is equal to 94.15. So there are two ways to look at it is 94.15 is the current market price basis 5.85 percentage per annum rate of interest that is coming out to be right on 100 rupees, and hence it becomes 94.15. So either we can take 5.85 as the percentage rate of interest or 94.15 as the current market price of the futures, right? Now, let's first make one more principle clear, that borrowing exposure is for 6 months and futures will cover me only for 3 months. Correct? Because the future time period is for 3 months, but the borrowing exposure is for 6 months. FRA 3 by 9, right? So for 6 months, the borrowing will be needed. So what should I do? So for 6 months borrowing, whatever futures are there, I will multiply with them 2. So I will take twice the futures exposure, because 2 into 3 will become 6 months, right? So whatever are the futures, I will just multiply them with 2. So now let's take here 4.5% and 6.5%. Okay. So first of all, I have to cover up for the prices that are going to increase, the interest rates that are going to increase. So what should I do in the futures market? Bonds futures, should I sell or should I purchase?
Still,
Yes, I should sell futures, right? Because the moment I sell futures, if the prices goes down, I will gain. And if the interest rate is going up, the futures prices are expected to go down. So I've devised a strategy where if I sell futures, I will gain in case the interest rate goes up. So in both the cases, it will be 94.15, 94.15. This is step one. Okay, step one, I will sell the futures. And how many number of contracts? Let's determine that as well. Number of contracts. So 50 million is the overall exposure value. 50,000 is the lot size of one futures contract. And as I said that 6 by 3, which is multiplying it by 2 because of the change in the duration. So this will become 2000 contracts. Clear? In the second part, price of futures. In the At the time of maturity, how much it will become? That's what we are trying to calculate. So first is the 4.5 percentage rate, and second is how much? 6.5 percentage rate, right? So this will become 95.50. This will become 93.50. Clear? Because here this is a 4.5%, this is a 6.5. Again, these are the annualized rate, students. Please don't think these are the actual rates. These are the annualized rates equivalent of 4.5 and 6.5. Okay. And hence the finally gain or loss. If I have sold bonds futures at 94.15, the rate has gone up at 95.5, I will lose, right? 1.35, I will have a loss, right? Similarly, I have entered into a short position of 94.15, actual rate is 93.50, I will gain how much? 0.65 I will gain. Clear? Because the prices has gone down. For a selling position, if the prices goes down, I gain. Now what will be the cash settlement on futures? Let's talk about that as well. Right here, 1.35 is on one future and the lot size is 50,000, right? And contracts that we have entered is 2,000, but this is equivalent to 3 months. Why 3 months? Because the rates at which this 94.15 and 95.5 is calculated is basis the annualized rates, students. Clear? So we cannot say that 1.35 is directly the loss of 3 months. It is an annualized loss. To arrive at 3 months loss, we have to multiply it with 3 by 12. So this becomes 337,500. This becomes a loss. Clear? Now, from a gain perspective, okay, from a gain perspective, 0.65 is the gain, 2000 is the number of contracts, 50,000 is the lot size. Again, 3 by 12 is what it will happen. So 1,62,500 will become gain. Okay. Now, finally, the interest on borrowing will be, I will just take it simply from here. This one, 11 lakh 25,000 and 16 lakh 25,000. So 11 lakh 25,000, 16 lakh 25,000. These are the net payments, right? So here there is a loss. So loss plus interest payment will be the total cash outflow, right? Which is 14 lakh 62,500. And here 1625 is the payment and 162,500 is the receipt, right? So the net amount is
500.
14,62,500. Yeah. So here let me write it this much plus 337,500. Here it will be 16 lakh 25,000 minus 1 lakh 62,500. Okay. So effectively, if you see in both the scenarios, the amount is restricted to 14 lakh 62,500. And if we try to calculate the effective borrowing percentage, this will be 14 lakh 62,500 divided by 50 million euros multiplied by 12 divided by 6, right? Because this is for 6 months. So the annualized percentage comes out to be 5.85 percentage. And this is the same percentage at which we have entered into futures. Right? So in the second case, we have finally proved ourselves that 5.85 is the effective rate of interest. And in the first case, we have proved effectively for us the rate of interest is at 5.94 percentage, students. Clear, students? I hope the way futures are calculated is understood and it is clear to all of you. Please do let me know in case you have any other questions. So till now, if I just want to recap quickly, we have discussed about why there is a need to study about the interest rate risk management because of the interest rate risk arising out of the dynamic feature of interest rates, right? We don't know what is going to be the actual interest rate. Now, how it can be addressed, we have discussed about the ALM method, asset and liability mismatch. Second is the forward rate agreements, and third one is the interest rate futures. So, forward rate agreements is very much similar to the forward agreements that we discussed in derivatives. Interest rate futures is very much similar to the futures in derivatives. However, only point to be noted is in case of interest rate futures, we don't have anything which comes as a futures on the interest rate. We have bonds futures, which are inversely proportional to the interest rate, and hence we have to devise our strategy accordingly. So, students, let's take a break of 10 minutes. After we will come back, we will continue with the interest rate options, which is guarantees, and some of the questions also in hand. Okay. So, let's again reconvene at 8:20. Sorry, 8:30. Yeah. Thank you. So let's now discuss about the interest rate options. Yeah. So let's talk about interest rate options, or we also call them as interest rate guarantees. So this is the fourth part. So again, now this interest rate options is the options equivalents of derivatives. So that means it gives us a right. It is not an obligation, right? It can be exercised under favorable conditions and it need not be exercised under unfavorable conditions. Similarly, because this is a right being given to someone, that other person will have to pay premium, right? As we discussed in the derivatives also. So so just to understand it better, again let's try to plot between two different versions. One is the cap option, second one is the floor option, right? Let's say there was a call option and there was a put option in derivatives. Similarly, there are two different options. Let's discuss with them. So let's say A is a contract which is giving you a right, or let's say privilege, but not an obligation. To what? To borrow. Okay, to borrow the specified amount. This is called as notional amount, right? The same thing at a specified interest rate on a specified date. Okay. Now, if you see what is the call, like let's say call option equivalent, cap option we are saying here. Cap option. Okay, so cap option means that it gives you a right to borrow a notional amount at a specified percentage of interest rate. Let's say 8%, 10%, which will really help to cap your borrowing rate. Because tomorrow, if the market interest rate goes up from the specified interest rate, then what you are going to do, you are going to just exercise the right of this option and undertake the borrowing through this. If tomorrow the market interest rate remains below this specified interest rate, then what you are going to do, you are just going to ignore this agreement and you are just going to the market and borrow it simple at the lower rate of interest. Clear? And similar to the call option, there is a buyer and there is a seller of this interest rate options, right? Yeah, student. So just to tell you, again, I'm just repeating for the sake of understanding. So, like call option is the option for the buyer of the underlying, right? So this cap option is the option for the borrower, right? Someone who needs to borrow. Similarly, floor options, these are the second type of options, interest rate options or interest rate guarantee, whatever we want to call it. So if it is A, which is again a contract, right, privilege, right, to what? To invest. This is for investment for the person who wants to invest. Specified amount, again we call it as a notional amount, at specified interest rate, right, on a specified date. Clear? So this is for the entities, this is for the people who want to invest. So what it will do, it will act for you as a minimum rate of return that you will get, right? So in the cap option, it will act as the maximum rate of interest that you are supposed to pay. Floor option is the minimum rate of interest that you will get by investing. I hope it is clear. Hence the name of cap and floor. Cap means you are capping the rate of interest for the borrowings. Floor means you are ensuring minimum rate of interest at a investment level. Clear, students? And similar to any other option, even floor option will have a buyer or a seller. Okay, we call them as a holder or buyer. So the buyer of floor option will be doing what? Will be the person who will be doing the investment. And there is a seller of floor option we are talking about. Or can we say that that person will be a borrower? Yes, that person will become a borrower ultimately. Because if the option is exercised, so the seller of the floor option will become borrower. Right? Similarly, for here, the buyer or holder is the one who is the borrower, right? This we are talking about the cap option. Let me just demarcate it so that, okay. So above this line is all we have talked about cap option. So in case of cap option, the buyer or holder of a cap option is in the borrower shoes, and the seller of the cap option is in the position of investor's shoe, right? The person wants to invest here because if the option is exercised, the person who has this option will borrow, and the person who has sold this option will invest or will lend, right? Similarly, for floor option, if the option is exercised, the holder or buyer of the option will have to lend the money, will have to invest the money, and the seller of the floor option will have to borrow. Now there is a concept of premium. Whether we talk about cap or floor, whatever we talk about, it is paid by whom? Paid by the, come on students, tell me, it is received by whom? Tell me, paid by who pays premium to whom?
The option purchaser, buyer of the option will pay.
Yes. And to whom it will be paid?
Writer of the option, seller.
Yes. Received by the seller of option. Okay. Now for cap, the buyer will be borrower. Again, I'm just writing it for clarity. For put, not put, this is floor option. For floor, this person will be investor, right? Received by seller. Seller in case of cap will be whom? Will be investor. And in case of floor, this person will be borrower. Okay. Now ultimately, the payoffs for buyer and seller of cap and floor. Let's discuss that as well. Payoffs for buyer and seller of cap and floor. So let's talk about cap option here. Let's talk about floor option here. Okay. So holder slash buyer. Here they have a right to borrow. Here they have a right to invest. Correct? Let's say 10% is the cap rate, 10% is the floor rate. Let's take two different cases, one for the cap and one for the floor. Here, this becomes the strike rate, right? The strike price that we used to call it as, this is called as strike rate. And the premium is actually 1% and 1% in both the cases. Let's assume it to be, right? The premium is paid by the holder. Now, if the actual interest rate comes out to be 12% in both the cases, let's assume this. Okay. Can you tell me for the holder of this option, whether there will be a gain or a loss or there will be nothing? Let's talk about the cap option first. So the strike rate is 10%, market rate has become 12%. Do you think there is a gain or there is a loss or there is nothing for option holder? Come on, students, tell me.
Sir, in cap option, it is gain of 1%.
Okay, if you adjust premium, then you are right. But let's ignore premium for a moment. Let's
Okay.
see only the strike price to spot price, right? So that is 2%
Gain of,
gain.
yes.
Okay. And in this case, in the case of floor option, if the market rate is 12%, the strike rate is 10%. So do you think that the person who has a right to invest at 10% for the rate what is appearing in market is 12% is a right anymore? No, right? Because this person will just go in the market and invest at 12%. So there is a 0% gain slash loss. The only thing is only 1% that the person has paid as premium will become a overall sunk loss, right? That is a sunk cost that will be there. Now let's take an example of actual interest rate being 8%. Now if it is 8%, so in case of a cap option, the person has a right to borrow at 10% and the market interest rate is already 8%. So do you think that person will exercise the right? The answer is no. So there is nil, right? Because this is not a right anymore. You are borrowing at 10%, but in market you can borrow at 8%. You will not exercise this right. You will just go in the market and borrow at 8%, right? So this will become option not exercisable, right? Because there are no favorable conditions attached to it. However, in case of a floor option, if you have a right to invest at 10% and the market interest rate is going at 8%, so would you exercise the right? Tell me yes or no. Will you exercise the right to invest at the rate of 10% under the options? Yes, you will exercise the right because you have a right to invest at 10%. However, market is only giving you 8%. This one, right? So ultimately 2% you will gain in the floor options. So I hope students this is clear. The interest rate options, the interest rate guarantee. Why do we call this as a guarantee as well? Because it is giving you a guarantee of the cap rate in case you are going to borrow, and it is giving you a guarantee of the floor rate in case you are going to invest. Clear, students? Please do let me know, students, in case of any queries or in case something needs to be discussed. Otherwise, let's move ahead on question number 3.
Clear, sir.
Clear? Okay. Now, question number 3, XYZ Limited borrows 0.15 million of 6 months SOFR. SOFR is secured overnight financing rate. So this is one kind of a, let's say, market operating index, right? For example, this is the rate at which all the banks deals within themselves, and this is a result of demand and supply of the credit in the market. If, let's say, the demand of credit in the market increases, the SOFR will increase. If the demand for credit in the market decreases, or let's say the supply of the credit in the market increases, the SOFR will go down, right? It's a game of all demand and supply. It's a part of the interbank market rate, right? And it's a variable rate. It keeps on changing every day, every second, because of the different deals that takes place in the market. So XYZ Limited borrows 0.15 million of 6 months SOFR plus 10%. So whatever is the 6 months SOFR going on, okay, 6 months maturity. So here let's connect our same principle. As I told you that different maturities have different interest rates. So 6 months will have different interest rates. So we are talking about the 6 months SOFR, but again calculated on a per annum basis. Okay. So 6 months SOFR is, let's say, 12% per annum. That means for 6 months maturity, 12% per annum rate is applied. Okay. Plus 10% is the spread. So basically, they are saying that bank will be getting deals on SOFR, which is the SOFR rate. Plus on that, they will be doing a 10% to to basically to cover up for the risk, to cover up for their margin, all those things, right? For a period of 24 months. So they are talking about 24 months period. The company anticipates a rise in SOFR, and hence it proposes to buy a cap option from its bankers at the strike rate of 8%. So they have given us, this is a question of cap option. Strike rate is 8%. The lump sum premium is 1%. 1% is the lump sum premium for the entire reset periods. So for the entire 24 months, right, the premium is 1%. And the fixed rate of interest is 7% per annum. So they have given us that apart from SOFR, the fixed interest rate that is going into the market is 7% per annum. The actual position of SOFR during the forthcoming reset period is as under 1, 2, 3. They have given data only for 3 reset periods. You are required to show how far interest rate risk is hedged through cap option. Now, some of you might be thinking, what is reset period? Now, see, students, reset period is the period, is the term, is the frequency defined in the agreement. In this case, let's say this cap option with the banker, it will say that the interest rate we will be seeing after every 6 months. Any change in the interest rate after 6 months, we will again adjust for it, right? See, there are different ways to look at it, right? One is that a person might say that we will see what is the interest rate at the beginning of the agreement, and accordingly we will take it for the entire 2 years. But in this case, they are saying that 2 years is the overall period, 24 months. We will not stick to only one rate for comparison. We will keep on checking it in the different reset periods. Okay. For calculation, work out figures at each stage up to 4 decimals and amount nearest to points. The it should be part of the working notes. Okay. Now, if I may summarize what is needed. First of all, we are talking about the borrowing position here, right? Because the company is in the requirement to borrow the funds. So amount required is 15 million. Cap option 8% against LIBOR slash, not sorry, against SOFR, right? Premium is 1%. And here, let's assume that there are 4 reset periods, although the data is given only for 3 reset periods. So, but we are taking an assumption that after every 6 months, the period of resetting is happening. So this is 4 into 6 is equal to 24 months, right? So each reset period is for 6 months. So can we say first of all, what is the total premium? See here students, we have to analyze that at every reset period, what is the net payoffs, right? Because then only we will be able to say how far interest rate risk is being hedged through cap option, right? If we are able to demonstrate that what is the actual outflow and what is the outflow because of this hedging, and the difference between these two will help us to know that what is the extent to which we are able to hedge our interest rate risk, correct? So let's calculate all the things that are required. So first of all, the total premium is on 15 million pounds into 1 percentage, which is 150,000, 1,50,000. Okay. Now this 1,50,000 is for all 24 months put together, is for all the 4 reset periods, right? That is mentioned in the question. 4 reset period, overall cost is 1,50,000. Now, if I have to identify for every reset period, what is the amount? Let's say I'm standing here, 1, 2, 3, and then 4. So there are 4 reset periods, right? So today itself, 1,50,000 is the amount. So what is the equitable amount in all these 4 reset periods? If I take a present value of that, it should be equal to 150,000, right? So I'm just trying to calculate what is the EMI for this 150 for the next 4 reset periods, because that will help me to compare it with the net payoffs that are happening during those reset periods, right? So if I just write it over here, and the rate of interest that I will be using here is the 7% per annum, which is the fixed rate that is given to us. Clear? So 1,50,000 is equal to, the first reset period belongs to 1 plus 7% divided by 2 plus x divided by 1 plus 7% divided by 2 raised to the power 2 plus x divided by 1 plus 7% divided by 2 raised to the power 3, right? See, first of all, this 7% is the per annum rate. 6 months rate will be 3.5% that we have taken here. So if I just take this, this is for the first reset period, raised to the power 2 is for the second reset period, similarly third, and similarly fourth. So this will give us, so if you take the equitable amount for all these 4 reset periods, it is 40,861 pounds, right? So these are the overall amount for every reset period that we are supposed to charge as premium in all these reset periods. I hope this is clear. Now let's calculate the net payoffs. Let's talk about reset period of 1, 2, and 3. Right? Let's restrict to the 3 reset periods for which data is given to us. What is the SOFR rate given for these 3 reset periods? 9, 9.5, and 10. So it is increasing, right? 9, 9.5, and 10%. So this has increased, right? Now, what is the strike rate? Or can I say cap rate? Is 8%? Correct? It is 8%. So now, as per the interest rate guarantee, or let's say this interest rate options, what all things will be compared? See, first of all, we will have to ignore this 10% because this 10% is fixed, right? This 10% is fixed. Now, if this 10% is fixed, so it will not really have any impact in the comparison because either you do like this in all the cases or you just ignore this plus 10% in both the cases, right? Whichever way you do, both of them are correct. But I'm just ignoring this 10%. I'm just comparing the SOFR with cap rate. Okay. So this SOFR is 9%. The cap rate is 8%. Now tell me, students, this we will be getting from the bank or we will have to pay to the bank. Is it beneficial to XYZ Limited or it is not beneficial to XYZ Limited? Come on, students, tell me. We are talking about a cap option. So this 1% is a right or it's not a right anymore. Yes, students, I hope anybody would want to attempt this. It's a very simple question. So my market rate is 9%. The cap rate at which I have agreed with the bank to borrow is 8%. So on a net payoff, will I gain 1% or I will not gain 1%? That is the question. I will gain 1%, right? Because, okay, let me explain this further. I think because it might not be clear. So we are talking about a cap rate, cap option here. Cap option will mean that the if the market rate interest is higher, then whatever cap rate you have agreed, you will exercise that. Correct? Now, in this case, you have a right to borrow at 8%. Against your right to borrow at 8%, the SOFR is appearing as 9%. So there is a 1% gain that you get on account of this option, right? So 1% on 15 million for 6 months, correct? Because the 6 months is the reset period. It becomes 75,000. Premium that we end up paying is how much? 40,861, right? This is the monthly premium that we are paying. Not monthly, this is for every reset period, sorry. Then finally, the net payoffs will be this 75,000 minus 4861, which is 34,139. Now, the next case, students, tell me, come on, for the SOFR being 9.5% and the cap rate at 8%, so the SOFR is the market rate of interest appearing at 9.5. Whether I will get any amount from the bank, whether I gain in this, the answer is yes, because now 1.5 percentage is the delta that I will expect from the bank because the market rate is 9.5. I have a right to borrow at 8%. Correct? So 1.5 for again 6 months. I will end up getting 1,12,500 and 40,861 will be the premium. So this becomes 71,639. This is the net payoff that we will get because of the second reset period at 9.5%. Now, similarly for 10% and a cap rate of 8%, because the actual interest rate is higher than the cap rate of 8%, we will receive a premium of, sorry, we will receive a delta of 2%, right?
But sir, in we are borrowing now, so we have to
Correct.
pay to the bank. Then how we will get gain?
Yeah, so I'll tell you. See, the question says is that it wants to borrow at for 6 months SOFR plus 10% for 15 million pounds, right? Till now it is clear.
Yes, sir.
And it is saying that the company anticipates a rise in SOFR.
Hmm.
So, see, the borrowing is already there,
Hmm.
right? If I may tell you, the XYZ Limited have taken two positions. Already it has borrowed,
Hmm.
okay, 15 million pounds, and that it has borrowed at SOFR plus 10%. Okay. Now, because the risk of SOFR being increased is there, so
Hmm.
the second action that XYZ Limited does is it buys a cap option.
Yes, sir.
Okay.
Hmm.
And it buys a cap option. Now, in the cap option, it says that 8% will be the strike
Hmm.
rate, right, for similar 15 million
Yeah.
pounds
Yes, sir.
and premium 1%, right?
Hmm.
Now basically what bank will do, and this buying a cap option has happened from a bank, from a different bank, okay,
Okay.
right? This one from a different banker. Now what bank will do, bank, now this SOFR is the actual interest rate that is appearing in the market.
Yes.
Assume this is a spot rate, right?
Yes, sir.
As per the derivatives definition, it is a spot rate. Now, spot rate keeps on changing. Now, that's what they have given us. It it is it is these values that are keeps on going to change for the different reset periods, right? And we are comparing this 8%, which is the strike rate, with the spot rate. And since it is a cap option, we are calculating the net payoff only on account of this option, right? Ultimately, XYZ Limited is paying on this borrowing equivalent to this amount. This is a separate transaction that is happening. Okay, on this, the interest cost is being paid, but we are only calculating the delta on account of this buying a cap option.
ओके इट
Clear?
मीन्स यानी अगर वो एक बैंक से बोरो कर रहा है तो वो सोफर प्लस 10
10% पे
टेन
बोरो कर
परसेंट
रहा है.
पे बोरो कर रहा है और अगर उसको वो दूसरी बैंक से बोरो करता है तो वो 8% प्लस 1% प्रीमियम से
नो नो नो, दूसरे बैंक से वो पर्सन सिर्फ कैप ऑप्शन ले रहा है. सी,
ओके
एक बोरोइंग एक ही बैंक से है, बट
हम्म
बिकॉज बोरोइंग में risk है सोफर बढ़ने का, इसलिए कैप ऑप्शन में उसने उस रिस्क को मिटिगेट कर दिया.
अच्छा
सो
ओके
देखो,
ओके
आप इसको ऐसे सोचो. सो फॉर एग्जांपल, आपने इक्विटी शेयर खरीदा,
यस सर
राइट? You have purchased a equity share. This is step one. Now, what you will do? You will take another position in derivatives market, right?
Yes,
You
sir.
will do either you will write a call option or purchase a put option,
Yes.
right?
Hmm.
तो उसने वो सेकंड स्टेप में ये करा है यहाँ पे, उसने फिर
Okay.
कैप ऑप्शन खरीद लिया
Yes, sir.
और उसने बोला कैप ऑप्शन में कि मैं 8% स्ट्राइक रेट पे खरीद रहा हूँ एट
Hmm.
1% प्रीमियम। तो 8% के स्ट्राइक रेट का मतलब ये हो गया है जो भी मार्केट में इंटरेस्ट रेट्स अप से या डाउन है उसके बेसिस पे स्ट्राइक रेट कंपेयर होगा सोफर के बेसिस पे एंड डिफरेंशियल विल बी पेड आउट और रिसीव फ्रॉम द बैंक।
Okay, sir.
क्लियर?
Yes, sir. Clear, sir. Thank you, sir.
बोरिंग एक ही बार है, बोरिंग दो बार नहीं हुई, ठीक है?
Yes, sir.
ओके okay, so then 2% here it will be the delta, correct? On 15 million for 6 by 12. So this will be 1,50,000 and 40,861 is the premium for this reset period. Again, the same transaction. So this will become 109,139 and the total amount is becoming 214,917. So for three reset periods, we have been able to mitigate this much of extra cost. How? See, this is the amount on account of net cap option receipts, right? This you will receiving on the net cap option. Similarly, you will be paying on your borrowings of 15 million, right? At what and what rate? So first one is 9 plus 10. So in the first case, what you will do 9% plus 10% into 6 by 12. This you will pay for the first reset period. Then on the second reset period, you will pay 9.5% plus 10%. This is the original contract I'm talking about with the bank, right? This is first reset period, second reset period, third reset period, 15 million on 10% plus 10% into 6 by 12. Similarly, fourth reset period also you will pay. We don't have the data. Let's say you end up in totality paying the interest of let's say 1 crore. I'm just taking a hypothetical example here, hypothetical number, right? So you end up paying 1 crore for the entire four reset periods. Now, out of that 1 crore, what we are saying is because you entered into the cap option, you are able to get a benefit of 214,917. So your effectively 214,917 will get reduced and your effective borrowing cost will be lesser. Clear? So this is the entire gist of the question. Now, if I may just conclude, the extent to which or extent by which interest option have hedged risk is pound 214,917. I hope this is clear, students.
Yes, sir. Clear.
Sure, let's do question number 4. Okay. Now, two companies, ABC Limited and XYZ Limited, approached the DEF Bank for FRA, Forward Rate Agreement. There are two different companies, but bank is one, DEF. They want to borrow a sum of 100 crore rupees after 2 years for a period of 1 year. Now tell me, what is the FRA? How should I write this FRA quotation? Come on,
2 by
students, tell
3.
me.
2
1.
by 3.
Very good. Yes, either you can write 2 by 3 or even you can write 24 by 36. Both of them are okay. Okay, 24 by 36 is the months if we talk about, 2 by 3 is the number of years if we talk about. So, because the starting point is after 2 years and the duration is 1 year, that means it will end after third year. Bank has calculated yield curve of both companies as follows. So what are the yield curves? XYZ Limited and ABC Limited, year 1, 2, 3. Right? Now these yield curves are what? These yield curves denotes the interest rate for that particular company from DEF. Let's say XYZ Limited. Okay, can anyone tell me what does this mean? 4.48 means. Just give it a try. Let's say this is given in the question, or somebody tells you that the yield curve of this company is this much. What does this mean? Please attempt to answer. There is nothing right or wrong because all of you might be hearing this for the first time. But please think through what this would have really be have a meaning of. Come on, students. I want to make it more interactive.
Sir, bid
Any
rate
ideas?
after 3 years, after second year,
Sorry.
bid rate.
So okay, no worries. I'll tell you. See, this means that if XYZ Limited has to borrow for 3 years, the applicable rate of interest will be 4.48 by the bank. Okay. Now, if XYZ Limited has to borrow for 1 year, 3.86 is going to be the interest rate applicable for 1 year borrowing. If XYZ Limited has to borrow for 2 years, it will be 4.2. Clear? So, it is the rate at which bank agrees to give the borrowing. Similarly for ABC Limited. Now, if you note here, ABC Limited is having a higher rate compared to XYZ Limited. Let's say 4.12 is higher than 3.86. 5.48, 4.2, 5.78, 4.48. Now, can anyone tell me, basis the first discussion that we had in today morning, I told you that interest is an outcome of two things. One is the time value of money, second is the risk. And I said you that risk will be different for different companies. Now, can you see here and tell me which one is more riskier company to borrow to lend to? Bank will assume which one is the higher riskier company.
ABC Limited, as bank is charging higher interest from it.
Very true. So this is ABC Limited because bank will say that since ABC Limited is having a higher risk, hence I've given the yield curve higher. So here the it is also mentioned the difference in the yield curve is due to the lower credit rating of ABC Limited. If the credit rating is lower, that means the risk is higher, right? So the same thing that we just now understood compared to XYZ Limited. Simple. Now you are required to calculate the rate of interest DEF bank would quote under 2 by 3 FRA, the same thing that we discussed, using the company's yield information as quoted above. So they are asking us to calculate the price of this 2 by 3 FRA. Suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of the loan, you are required to calculate the interest payable by XYZ Limited if the interest rate in 2 years turns out to be this much. Okay, so they are saying if let's say the bank is giving an interest rate guarantee. Now the strike rate is not given. we will have to calculate the strike rate, right? Which is again using the same 2 by 3 FRA. Okay, so let's calculate step by step. Let's come to the solution. So we are talking about a FRA of 2 by 3 here. Okay, let's talk about X, Y, Z Limited, the first company. Yes. Now we have to calculate for 2 by 3. So what all rates I should use? Is this rate relevant? Sorry. Is this rate relevant for calculating 2 by 3? Okay, if we are getting confused, so let's make it over here 0, 2 years, and 3 years, right? So this is the FRA that we have to calculate 2 by 3. So that means we need this rate and overall 3 years rate. So we need 2-year rate, we need 3-year rate, and this we can assume X to calculate the FRA of 2 by 3, right? We discussed about the valuation or the pricing of these FRAs, right? So 3-year rate will is actually how much? 4.48. 1 plus 4.48 percentage raised to the power 3, because 3 times we will do the compounding, right? Will be equal to 2 years rate for 2 years. 1 plus 2 years rate is 4.20 raised to the power 2 multiplied by 2 by 3 is what we have to calculate. Let's assume it to be x. So 1 plus x percentage raised to the power 1. So if we solve for here, we get x is equal to 5.04% students. Clear? So 5.04% is the FRA that would be quoted for XYZ Limited by DEF Bank. Clear, students? Now, similarly, can we calculate for ABC Limited? So this is 1 plus. What is the 3-year rate? 5.78%. For 3 years is equal to, what is it is going to be for 2 years? 5.48, right? Right? This is the same concept, same formula. So the X percentage becomes
6.38.
very good, 6.38. Very good. So FRA for 2 by 3 is 6.38 percentage. This is for ABC Limited. Students, I hope this is clear. Please do let me know in case of any queries, clarifications, questions. Again, I am asking. Okay. Now, let's come to the second. So this part was very easy, right? Then second is, suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of loan. See, first of all, premium is 0.1 percentage of the amount of loan. What is the amount of loan? 100 crores, right? This one. And they are giving an interest rate guarantee. Again, this is an option, interest rate option. Now, for this interest rate option, we need to find out that what will be the strike rate. Okay, sure, Pooja. Thank you. Now, if let's say the interest rate guarantee or option is given by the bank to XYZ Limited, we need to first of all find out what will be the strike rate. Then only we will be able to determine whether due to these two different actual rates there is a interest payable or not, right? So can anyone tell me what will be the percentage for XYZ Limited that the bank will give as a strike rate? Come on, students. Can anyone guess this? See, the question is silent on what is going to be the strike rate. But the answer is obvious. The FRA rate that you have calculated is going to be your strike rate. Clear? Why? Because the bank of the question is in the continuation in the flow, it is saying that the bank offers interest rate guarantee for the amount of loan, right? In the first part it is asking you to calculate the bank's FRA rate. So at the same rate bank will offer you a interest rate guarantee. Okay, so here the cap rate is 5.04 percentage. The premium is 0.1%, right? And the notional amount is 100 crores, right? Now, this is for XYZ Limited that we are talking about, right? Because the second part is only restricted to XYZ Limited. It's not talking about ABC Limited. Clear? Now, XYZ Limited is in the borrowing position. Yes, because it mentions that it wants to borrow, right? So if it is in a borrowing position, the interest rate guarantee will be for the cap or for the floor. It will be for the cap, right? Because you are entering the borrowing position. So you will have to enter into a cap, interest rate cap. Okay. Now, if it interest rate is in if the interest rate cap is 5.04, we have been given two different cases, 4.5, 5.5. Let's evaluate them. So if the interest basis 4.5 will be calculated as like this, 4.5% into 100 crores for 1 year, right? Why? Because in this case, when the actual interest rate is 4.5, would we be going to utilize the interest rate option at 5.04%?
No.
No. Yes. Why? Because 5.04, under that option, I have a right to borrow at 5.04. But in the market, the interest rate is already 4.5%. So I will go in the market and borrow at 4.5% and end up paying interest at 4.5%, right? So this will become 4.5 crores, and the premium on this will be 0.1% on 100 crores, which will be 0.1 crore. So the total net payout under both the borrowing as well as under the interest rate guarantee, it will be 4.6 crore. Now, if I talk about 5.50% and the strike rate is 5.04%, so would I exercise the option? The
Yes,
answer
sir.
is yes, because yes, the answer is yes, because 5.04% is actually a benefit to me now, because I will be able to borrow at a lower rate compared to what it is appearing in the market. So my interest rate will be capped at 5.04% on 100 crores for 1 year. So this will give me 5.04 crores. 0.1 crore will still be there for premium, and hence I will end up at 5.14 crores. Still, it is lower than 5.5 crore, right? Had I have not been entered into this, I would have ended up paying 5.5 crore, which is the actual rate of interest. So, because of the interest rate guarantee that I have entered into, I am able to mitigate the risk of interest rate changes. Clear? So the best one in this case is equal to the interest rate options from a holder perspective, right? Because in case the prices goes down, in case the interest rate goes down, you are able to reap the gain. In case the interest rates are going to go up, in that case your interest cost will be limited or will be capped to the cap rate, or which is the strike rate. Okay. Now let's come to question number 5, students. I hope till now the questions are clear. Let's
Yes,
move
sir.
ahead to question number 5. Perfect. Now, question number 5 says TMC Holding Limited has a portfolio of shares of diversified company valued at 400 crores, enters into a swap arrangement with non bank on the terms that it will get 1.15% quarterly on notional principal of 80 crores in exchange of return on portfolio, which is exactly tracking on the Sensex, which is presently at 21,600. Now, please don't get, let's say, confused. The question is very simple and very easy. First of all, it is talking about something as swap. Okay. Now, what is swap? Swap is exchange, right? If you just see, swap is a very fancy word, but it has a very small literal meaning, which is called as exchange. So I am exchanging something. What I am exchanging here? 1.15 percentage on a quarterly basis on some notional principal, okay, is getting exchanged with the Sensex returns. See, what is the Sensex? Sensex is the collective index of certain companies. What is the direction in which they are moving, right? It is an index that tells you if Sensex is up by 10%, that means on an average in the market, 10% increase has happened over the period of time. Clear? Now, if let's say this starting point is 21,600, if Sensex is going, let's say, up by 2%, then again down by 3%, then again up by 4%, something like this, right? If the Sensex is giving you some returns, these are being exchanged with the 1.15 percentage fixed. So this is a swap, right? Wherein I will be getting 1.15% fixed, and I will be paying Sensex percentage, whatever that percentage return equivalent comes, that I will be paying. Okay, clear? So this is a very simple fact that is given. Calculate the net payment to be received or paid at the end of the each quarter if the Sensex turns out to be 1, 2, 3, 4. They have given us 4 different quarters related value. Okay. Clear? Now this 80 crore and 400 crore is a bit confusing. Okay. Now just please understand it that they are just saying that 1.15 on every 80 crore you will get, but since you have a portfolio of 400 crore, the value which you should calculate is on the 400 crore, because that's your overall investment value. Okay. So if I talk about TMC holdings, so here it will get 1.15% on 80 crores. Effectively that means 1.15% on 400 crores, right? Whatever notional amount you want to take, you can take. Either you can take 80 crore also, that's also fine, or you can take 400 crore also. I'm taking 400 because overall investment value is 400. Okay, so the return is fixed, right? Fixed return of 1.15% on 400 crore, which is equal to 4.60 crore per quarter, right? For every 3 months, you will be getting this amount. TNC Holdings will be getting this amount. And the pay basis Sensex returns, right? So, howsoever in whichever direction Sensex moves, basis that you will have to pay. Now, let's evaluate that. Let's put quarter. Then we will put the absolute Sensex value. We will put the percentage in Sensex that has changed. Then amount in absolute term, which is 400 crore multiplied by percentage. This will come in the absolute basis. Then the fixed return that we have got. And finally the net amount. So this is 0, 1, 2, 3 and 4. Clear? So the Sensex is
21,600.
21,600. Yes, on the 0th quarter. It moved in the next quarter to 21,860. Then in the next quarter, it came down to 21,780. Then it moved up to 22,080. Then again it came down to 21,960. Clear till now? Now the Sensex returns in percentage is nil here, right? In the first quarter end, the Sensex has moved up to 21,860 from 21,600. So it has, in a nutshell, so I'm just writing it for the first quarter, 21,860 minus
21,600
21,600. Yes,
divided by
divided by
21,600.
21,600. Yes,
1.20%.
perfect. So it is 1.2037 percentage. Very good. Okay, so this is 1.2037 percentage. Now for the second quarter, the movement will be
Downwards movement.
21,780. Yes, then what should I write here?
Minus 21, 860.
Very good. Because I will not be writing 21,600. Why? Because this movement we have already captured in the first quarter. So now from the next quarter, we will take it from 21,860 divided by this. So this becomes, now just note here, it is a negative return. The Sensex has dipped, right? So it means there is a negative return of 0.3660 percentage. Right, then simply for the third period, it will be calculated as 22,080 minus
21,780.
21,780, yes, divided by 21,780. So this will be
3774.
1.3774. Very good. Yes, so this will be the number 3774 percentage. Right? And finally, we have 21,960. The last quarter will be calculated as 21,960 minus 22,080 divided by 22,080. Again, here the Sensex has come down. So
Negative
it will give a negative return. Yes,
5434. 35.
0.5435. Very
35.
good. 5435. Yes. So this will be minus 0.5435 percentage. Now let's put this percentage on 400 crore. Okay. So in the first quarter it will be nil. Here it will be 400 crore into 1.2037 percentage, which is this. It will give us 4.8148. Okay. Then on the negative 0.3660, it will be minus 1.4640. Correct? Again, minus 0.3660 multiplied by 400 crore. This will give us this much. The third one, 1.3774 percentage on 400 crore, it will be 5.5096. Then minus 0.5435 percentage on 400 crore will be minus 2.1740. Now students, I have a question here. So as per the arrangement, we were supposed to pay basis the Sensex returns, right? So quarter one and quarter three are okay with us because the Sensex has increased and we come to know that okay, 4.8148 has to be paid for quarter one, and for quarter three, 5.5096 has to be paid. But what about quarter two and quarter four? Because quarter two, does this mean that we have to receive as per the arrangement for quarter two and quarter four being negative, or where the Sensex has come down? So under this leg of swap, do we really mean to receive the amounts? Come on,
So
students.
bank has done arrangement for fix 1.15.
Correct. So that bank, so that we will pay to the bank. Sorry, that bank will pay to us. Right, so this 1.15 bank will pay to us, but as far as TMC holding is concerned, so 4.814, yes, it will be paid to the bank. 5.5096 quarter 3, yes, it will be paid to the bank, but this minus 1.4640, which is quarter 2 and quarter 4 respectively, will be recovered from the bank. Okay, this is the point I was trying to say, that since the Sensex has come down and we are not talking about anything on the option, right? We are talking about the absolute obligation. Hence, whether positive or negative, it has to be paid or recovered only on account of this, right? So the fixed return that we will get is 4.60, 4.60, 4.60, and 4.60. Okay, and hence the net amount will become, this is, let's say, A, this is B, so this will become A minus B. Okay, so 4.8148 minus 4.60, it will become 0.2148. So I'm just writing to show it as a net payout as minus 0.2148 is the net payout. Here it will be, this is also a receipt and this is also a receipt, right? So we will add both of them to arrive at 6.0640. Here this is a payment and this is a receipt, correct? So we will write that accordingly. So 5.5096 minus 4.6, it becomes minus 0.9096. And at last, for the fourth period, 4.6 is the net receipt and 2.1740 is also
Both
the
are
net receipt.
receipts.
Yeah, both are receipts. So we will take it as 6.7740. Dear students, any questions till now, students? So now we have to start the last, I think, instrument, which is the interest rate swap. But I don't feel we will be able to cover given the time. So let me do one thing. Let me just see if some other question which is not dependent on that swap we can do. Meanwhile, if you have any questions, students, please do let me know. I think most of them have swap discussions. Okay. So let me do one thing. Let me quickly have a revision on what we have discussed till now. Or maybe yes, I got a question number 6. Let's do that. Yeah. So question number 6 is a independent question of that concept of swap that we will discuss in the next session. Okay. So now question number 6, students. Consider the derivative bank entered into a swap arrangement on a principal of 10 crore and agreed to receive MIBOR overnight floating rate for a fixed payment on the principal. Now this is a derivative bank. Okay. So the derivative bank did what? Derivative bank agreed to receive MIBOR means Mumbai Interbank Offered Rate. So whatever in the Mumbai's market interbank rate is appearing, that is called as MIBOR. So MIBOR overnight. Overnight means for 1 day financing. For 1 day financing, what is the rate? Right? Because if you take a credit for 1 day, what is the rate that is going to be? And it will pay a fixed payment on principal. The swap was entered into on Monday 19th August 2019 and was to commence on 20th August 2019, which is the very next day, and run for a period of 7 days. Respective MIBOR rates for Tuesday to Monday, that means for these 7 days, are as follows. So this is for Tuesday, this is for Wednesday, Thursday, Friday, Saturday, and Sunday will be the same rate, and then finally Monday, right? 1, 2, 3, 4, 5, 6. Although days are 7, but they have given us 6 rates because Sunday is a holiday. So that's what they have mentioned here. Sunday is a holiday. So the same rate of 8.15 will apply for 2 days, which is Saturday and Sunday. If the fixed rate of interest is 8%, that is this, right? Then evaluate the nature of this swap arrangement. First of all, they're asking us to evaluate the nature. Then second is the net settlement amounts. Okay. Consider 365 days work in the rounded rupees. Now, as we discussed, derivative bank is receiving MIBOR and paying fixed. So first of all, if we evaluate the nature of this swap, this is just a fixed to floating or floating to fixed swap, right? And it's a plain vanilla swap. See, again, I'm saying swap is just an exchange. I'm just exchanging my obligation of, I'm just exchanging my obligation in such a way that under this swap, I receive floating and I keep on paying fixed. Okay. The given swap is plain vanilla. So why do we call this term plain vanilla? Means without any added characteristics. It's just a plain vanilla overnight index swap. This is called as OIS. Why overnight index swap? Because this is given in the question itself. They're talking about the MIBOR overnight floating rate, right? So this is just simple explanation of what it is. Now we have to just calculate the amounts, right? So calculation of net settlement amounts. Okay. So let's talk about from the day's perspective here. The principal, MIBOR percentage, and hence interest. So this is the running principle, okay? Because every day the interest will be getting calculated and it will get added, okay? So let's start from Tuesday as the question suggests that actually it is going to start from Tuesday. The principal amount will be 10 crores. This remains unchanged. MIBOR percentage on Tuesday is how much? 8.15%. So the interest basis 8.15% for one day comes out to be 22,329. How this is calculated? 10 crores into 8.15 percentage for 1 by 365 days, right? So then for Wednesday, the opening will become how much? 10 crore plus this interest of 22,329. So 10 crore, 22,329, and the MIBOR on next day is 7.98%. Now instead of 10 crore, you will apply the interest on the running principal. for 1 day, right? So this becomes 21,868. Then similarly, Thursday, your opening principal will become Wednesday principal plus Wednesday's interest. So that is 10 lakh
10 crore
44,000.
197.
Yes, 197. Perfect. And on Thursday, the interest will get applied basis 7.95%. The amount comes as 21,790. Then for Friday, the carried over principal will be this plus this, which is 10,000, 10 lakh, 10
10
crores,
crore 65,000
65,987.
987.
Perfect. Then on Friday, we have the rate of 8.12%. This will give us an interest on this principal as 22,261.
261.
Right. Then finally, for Saturday and Sunday, 2 days we will calculate together. The opening principal will become 10 crore
248.
88,248. Yes. Then this 8.15 will be calculated for 2 days. So here we will just do 2 divided by 365 in the interest formula. Okay. So this is 44 697.
697.
Perfect. Then on Monday, the opening will become 10 crore 01 32
945.
945. Yes. And this will be basis 7.75 percentage. This will become 21,261, and hence the total amount of interest, if we do, it comes as 1,54,206. This is amount to be received because we are receiving the MIBOR amount, right? Fixed amount to be paid. Fixed amount to be paid will be how much? 10 crores into 8% for 7 days, right? 153
425.
425. Perfect. So the net amount to be received is 781. So this is how the swap arrangement has impacted on the net amount to be received or to be paid. There is one good variation in this question that we have seen sometimes how it happens. So let's say you will be given this and you will be given all the information to calculate this. They might ask you that what is the interest rate. Accordingly, you will have to calculate first this value. Step one will be calculation of this value, and basis that you will arrive at the back calculation of this fixed percentage, right? So I'm saying ki so there might be cases where some missing information will be given and the net payoff will be given, right? So the numbers has to be arrived at accordingly. Clear? Now, I think this question number 6 is also done, but I'm just wanted to take you through this again. This overnight index swap, this means that you are swapping the MIBOR overnight rate with other fixed payments, right? Which is the 8% in this case. So don't get just confused with the term. Overnight index swap means for whatever the interest rate is appearing in the market for overnight borrowing or lending. overnight means only for one day. So today I borrow and tomorrow I return it back. Or let's say today I invest or lend, tomorrow I get the money back. Simple like that. So for that, whatever is the rate appearing in the market, if I swap it with the fixed rate, that is called as overnight index swap. And the rate that appears for overnight is called as the MIBOR overnight floating rate. I hope the concepts that we have discussed in today's session along with the questions are clear, students. In
Yes,
case of
sir.
any queries, please do let us know. Clear? Okay.
Yes,
So
sir.
yeah, I think from today's session, I think that is all from my end. Yeah, so I request Siyashi sir to please help with the concluding remarks. Thank you.
Thank you, Deva sir. Uh, in
Thank you,
today's
sir.
session, sir, I think at 7, I think 7:1, this is Ms. Supriya G has also sent you the reply that you were asking.
Yes,
Yeah,
yes,
yeah.
sir. Yes,
Is a compensation for this. Your reply was correct.
yes,
Okay, student. Now,
yes.
today we have started with the interest rate risk management. When sir was sharing his views on the interest rate risk management, and initially when we started, the topic was FRA. Okay, so in FRA, basically forward rate agreement, we are entering into an agreement for the forward period. Okay, so say today is zero period, and after 3 months we want to borrow the money for the 3 months. So it comes 3 into 6. So if you recall, there is a topic in security valuation. Topic is yield curve, and from yield curve we can derive the spot curve, and from spot curve we can derive the concept of forward curve. So you can see that uh, we can judge that we this topic. One second. Hello. But here we have uh, uh, in because for from the security valuation topic, if you link it, so you can see that the topic that we have discussed forward curve there, now it will be used here. Now sometime even this can also be used for the hedging purpose, because when we come you know that if I want to derive the rate of, if I say I want to know the rate of interest of after 3 months, what will be the interest for the 3 months after 3 months. So I can say that if I want to find the rate of forward rate, I can find it. Once I find it, so by using the forward trade agreement, even I can do the arbitrage. Suppose if this rate comes out to be by using the forward rate curve. If you recall that, suppose I just have give you a very simple example. Now suppose 6 month our now the Libor has been no more. So it will be, I can say it is a SOFR. It is say 7%. Okay, and suppose if for the 3 months the SOFR is say calculator. It is somewhere around say 5%. Okay, now I can came to know what will be my rate of interest after 3 months for the period of 3 months. So I can do like that 1 plus 0.074, okay, raised to divided by 4 raised to power 2 divided by 1 plus 0.05 divided by 4, this way minus 1. So I just do it. It comes around 0.07 divided by 4. It's 1.0175 into 1.0175 divided by 1.0125. Okay. Somewhere it comes around 0.025. And if I multiply it with 4, so if I multiply with 4, it comes 4.09 something. So after 3 months, sorry, not 3 months, sorry, it is somewhere 0.0225. Yes, it will be become 9%. My mistake. If I multiply, it will become 0.9. So it will become 9%. Now it is let us know what will be the expected rate after the 3 months for the 3 months period. So now if the forward rate contract are available, is selling at say somewhere around 10%. So we can sell the forward rate agreement and borrow the money in this manner. So this is, we can see that from the forward rate curve, even we can do the arbitrage. So I hope the student, this concept must be clear to you, forward rate agreement. Now in this session, next session, we shall continue our topic and we shall complete the topic of interest.
Concluding this.
Conclude this.
Yes,
So
sir.
student, if you have any query, you can send us at 0120 3045 956, or you can send us email at sfm-final@icai.in. Okay. I think Pooja, you have sent some email to me, but please also mention your phone number because I am trying to figure there are your 1 or 2 issues are regarding your eligibility criteria is there. So please just share your phone number as well so that I can get you connected with the concerned person. Okay, student, thank
Okay,
you
sir.
very much. If you have any query, you can ask. Just message. Okay, thank you, students. Okay, have a nice day. Okay, Devas sir, thank you very much for sparing
Yeah,
your.
thank you. Thank you, sir. Thank you.
Letting
Thank
go,
you.
student. Thank you very much.
Thank you, sir. Have a nice day.
You too, beta. You too.
Thank you.
Thank you,
Thank you.
sir.
Yes, session over.